Still waiting for the right time to invest? Look, I'll be blunt. You're already falling behind. Now, after working with hundreds of investors, I've seen one mindset shift that turns watchers into winners. I'm going to walk you through 5 of the biggest market crashes in history and show you exactly why the smartest investors didn't run. In fact, they leaned into the crashes and they followed one rule that works every single time. And if you want everything you need to profit from stocks laid out clearly and simply, I've put together a free blueprint you can download below. It's the very same blueprint that we have used to stay invested, cut through the noise, and grow our portfolios no matter what the market is doing. Okay, so let's set some context. You probably have membership to one of 2 clubs. The market's going up, I've missed my chance club, or the it's going down, it's too risky fraternity. Maybe even a lifelong member. Membership on direct debit. Here's what I say. We both know you're telling yourself a story to feel better about doing absolutely nothing. But deep down, it's eating you up. And it should be. Let me tell you a quick story. March 2020, the impact of COVID-19 is peaking. Volatility spiking. The market drops 34% in just 23 days. Most retail investors, no plan, just pure fear and reaction. Now, our stop losses, of course, were firing across the board, one after another. By the time the dust settled, we were actually down around 20%. But here's the thing, this wasn't unexpected. It was our system doing its job. We risk small, we set our stop losses, so when the unlikely happens, our downside is protected and calculated, and we're still very much in the game. Let's be honest, the community was rattled when COVID-19 hit. Most had never lived through that kind of speed and volatility before. So we kept the message very, very clear. Stay calm, let the market settle, focus on what we can control. And 18 months later, the S&P 500 had bounced back almost 120%. The losses were gone, and more than that, we had access to stocks that didn't just recover, they doubled accounts. The lesson here, the bigger the fear, the bigger the opportunity. And COVID-19 wasn't even the fastest recovery we've seen, not by a long shot. Let's go back to late 2018. The US-China trade war. Of course, trade wars aren't anything new. It's December. Headlines are screaming recession ahead. The Fed's hiking rates, tariffs are flying, tech stocks are getting hammered. And the S&P 500 nearly drops 20% in a single quarter. The usual panic kicks in, but 4 months later, market fully recovers. New all-time highs. Inside our community, we kept it again very simple. Fear isn't a flaw, it's part of the system. The market drops, it finds support, then it turns, and if you know where to look, you don't need to second guess. You wait for the right setups, and then you ride the reversal all the way back up. Okay, 2008, most people remember it for the panic. We remember it for the setup. The global financial crisis, the S&P 500 dropped 57%. Brutal for many people, but not for us, because again, it wasn't a surprise. Those who knew how to read the market cut out of their long positions, locked in profit, switched their bias from bullish to bearish, and actually shorted the move down. Then when the market confirmed a bottom, we flipped our bias back from bearish to bullish and then rode the next decade up. That's a massive 400% climb in the S&P 500, which has only continued to rise, stacked with some of the most profitable stocks we've ever seen. You should really be starting to see the pattern here. Big drop, bigger recovery. That's what happens when you stop reacting and start following market trends. Okay, look, I get it. Short-term chaos is real. Let's rewind to the 2010 flash crash. The Dow dropped 1,000 points in minutes, triggered by a trading error. People thought the whole system had broken. Panic headlines don't change the plan. They just test whether you have one. A few days later, the market had fully recovered again. Same thing in 2016. Brexit hit. Global equities dropped 10% almost overnight. 2 weeks later, back to normal. Again, see the pattern? The market always overreacts. Our job as investors isn't to predict it, it's to prepare for it. We define zones in advance, areas where the market is likely to bounce. Then we wait. We watch and we strike. Even in 2022, the S&P 500 was down 27% for the year. From the 2022 low to the February 2025 high, a 75% move up. And here's the thing that most people miss. Even during major declines, we were finding strong stocks, names like Berkshire Hathaway and Cencora, that barely blinked. While the market dipped, these stocks pushed to new all-time highs. You see, you don't just ride it out, you manage risk, you rebalance the portfolio, and when the market confirms strength, you start buying and compounding from a position of control. Because markets don't just fall, they reset, they reload, then they run. So here's my challenge for you. Stop waiting, start preparing, and treat every market drop like it's your invitation to build wealth. Look, let's call it for what it is. Most people lose money in the market, and it's not because they aren't smart. It's because their approach is wrong, amateur, incomplete, driven by greed. They take trades they shouldn't, risk money they can't afford to lose. And when things go south, well, they panic. Sell at the bottom, regret it later, repeat. Here's what we do instead. We focus on everything we can control, from when we enter the market to which stocks we buy, to how we allocate risk, compound into strength, and exit management. All of that is mapped out before any single position is taken. We let go of the one thing that isn't in our control, the outcome of any single position. And because our risk is managed, we don't need to worry about it. The hallmark of a good investor is very simple. Pick the right stocks, protect capital, and let the money come to you. When you focus on the process, not the money, the profit takes care of itself. And here's the thing, in absolute abundance. Now, zoom out. Since 1928, the S&P 500 has averaged around 10% a year. It's been positive 70% of the time. There have been 27 corrections since World War II. And in 80% of those corrections, the market was higher only 1 year later. Every bear market in history eventually followed by a new all-time high. That's not speculation, it's absolute fact. And that's what we look at as investors. So when someone says, wait until things calm down, what they're actually saying is, wait until the stock market is even more expensive. That's not how we operate. We follow trends, we manage risk, we treat corrections like clearance sales. Get rid of the bad stocks, hold those strong stocks. Fear is ultimately a feature of the market. It shouldn't be treated as a flaw. Every major market drop you just saw, from the global financial crisis to COVID-19, wasn't a sign to panic and run. It was an invitation, an opportunity to build wealth while everyone else, well, panicked. But, and this is the key, only if you have a process. This isn't about predicting the next crash or timing the perfect entry. It's about being prepared before it happens. Because if you don't know how to handle volatility, manage risk, and position yourself correctly, then every drop becomes a threat instead of the chance it really is. That's why you need to watch the next video. It walks you through the exact weekly process I use to find profitable stocks that grow my account an average of 30% per year. The same process that helped us stay calm through the chaos.